Welcome to the Deep Dive.
Great to be here.
Today, we're diving into Alphabet Inc., Google's parent company.
That's right. We've got a pretty detailed financial analysis report as our guide.
And our mission, really, is to pull out the key insights for you, the business, the finances, the challenges ahead.
Exactly. We'll be looking at revenue breakdowns, competitors, valuation, using a sort of Buffett-style DCF.
We'll also touch on what value investors are doing, right? Board members, voting stuff, buybacks.
Recent earnings, the whole financial history. It's quite comprehensive.
And here's a little hook to get us started. You might be surprised just how much one thing still dominates their income, even as they push hard to diversify.
It's a persistent theme.
Okay, so let's unpack this giant. Where does the money actually come from?
Well, the report is clear. The core is still online services, basically Google fueled mostly by advertising.
Like search and YouTube ads?
Precisely. Search, YouTube, their ad network partners. Then you've got Google Cloud, which is becoming more significant. And there's other Google subscriptions like YouTube Premium, Google One, apps, hardware like the Pixel phones.
Okay.
And finally, the other bets, those more experimental long-term projects.
Got it. So the numbers for 2023, how did that break down? What slice of the pie did each get?
All right, so total revenue in 2023 was about $307.4 billion, a huge number.
Wow.
And a staggering 77% of that, roughly $238 billion, came from advertising.
77%.
Yeah. And within ads, about 57% was Google search and related stuff, 10% YouTube ads, another 10% from the network.
Okay.
Google Cloud brought in around 11%. Other Google, the subscriptions, hardware, et cetera, also about 11%.
That's your famous other bets.
Less than 1%. That includes some hedging gains too.
Yeah.
But yeah, minimal impact on the top line for now.
Less than 1%. That really highlights the ad dominance, doesn't it? 77% is just massive.
It really is.
So what are the key insights we should take away from that distribution?
Well, it's sort of a double-edged sword, On one hand, that huge ad revenue from search and YouTube gives them this incredible scale.
A competitive advantage?
A huge one. A moat, as Buffett would call it. Their massive user base is hard to challenge.
But the other edge?
The risk. Heavy reliance on digital ads makes them vulnerable to economic downturns, shifts in the ad market.
We saw a bit of that in 2022, didn't we? Ad growth slowed, profit dipped.
Exactly. It shows the potential vulnerability.
So it's this powerful engine, but maybe too powerful. They need other cylinders firing. The report mentions diversification efforts.
Absolutely. They're pushing hard on Google Cloud. It showed really strong growth, 32% year over year in Q1 2024.
That's significant growth.
Very. And they're trying with other non-ad businesses too. But historically, these areas, especially cloud and other bets, haven't always been profitable. They've often run at a loss.
Right. So it's a balancing act.
Totally. Leveraging the ad cash cow while building up these other pillars for, a more resilient future.
Makes sense. Okay, looking ahead then, what are the big headwinds? The major challenges facing Alphabet in, say, 2024, 2025?
That's a critical area. And the report flags several big ones. First up, regulation and legal fights.
Ah, the antitrust stuff.
Exactly. They had that big ruling late 2024, a U.S. court finding they abused their search monopoly.
And the consequences of that.
Still playing out. The remedies phase is set for 2025. Could mean major changes, maybe even breaking off parts of the business. Big fines are possible too.
And that's not all, is it?
No. Separately, they were found to have monopolized online ad tech. Plus, you've got similar scrutiny in the EU and elsewhere. It's a global regulatory pressure cooker.
Sounds like a serious headache. What else are they up against?
Competition, especially in AI and search, that's heating up massively.
Like Microsoft putting ChatGPT into Bing.
Precisely. That's a direct challenge to Google's search dominance. Google's hitting back with Bard, now Gemini, integrating AI into search results.
It's an arms race.
It really is. The CEO basically said underinvesting in AI is the bigger risk. Plus, you still have competition from TikTok and others for video and social ad dollars.
So tech battles on one front, legal battles on another. What about the economy, the big picture?
Yeah, macro factors always play a part. Economic slowdowns mean businesses might cut ad spending.
Right.
The report mentions specific worries early 2025 about big spenders like Temu and Shein potentially pulling back.
Interesting. Any other macro things?
Changes in trade policy, like the U.S. ending the de minimis tax break for small imports, could slightly hit e-commerce ads. And then there's just general global tension, inflation. It affects advertiser confidence.
Management knows this, presumably.
Oh, yeah. They've explicitly said they're not immune to the macro environment.
Okay, those are external pressures. Any internal cost issues?
Definitely. Building out all this AI and cloud capability isn't cheap. Operating expenses are up. Hiring AI experts, building data centers.
They did have layoffs in 2023, though.
They did, yeah, trying to find efficiencies. But investors are definitely watching the ROI on all that AI spending. It's another balancing act, invest for the future versus keeping margins healthy today.
Okay, they certainly have a full plate. Now let's try and figure out what this all means for the company's actual value. The report uses a Buffett-style DCF, a discounted cash flow analysis. How does that work?
Right, so this approach tries to value Alphabet, like Warren Buffett might. It looks at the future cash the business is expected to generate for its owners.
Owner earnings.
Exactly. Free cash flow is used as a stand-in for the cash left after running the business and reinvesting what's needed. Then you project that cash flow out into the future.
And discount it back.
You got it. Discount it back to today's value using a discount rate. The report uses 10%, which reflects the time value of money and risk. Buffett often uses something similar for stable, large companies, and the growth assumptions are pretty conservative.
What numbers are we talking about?
It started with a base 2024 free cash flow estimate of around $72.8 billion.
Okay.
Then assumed 8% annual growth for 5 years, then 5% for the next 5, and a final long-term growth rate of 2.5%.
That sounds quite modest compared to their history.
It is. It reflects that, a company this huge can't grow at hyperspeed forever. It's a mature business in many ways.
So running those numbers, what intrinsic value did the analysis come up with?
Based on those assumptions and the 10% rate, the calculated enterprise value was about $1.57 trillion.
Enterprise value, so before cash.
Right. Adjusting for their net cash, the estimated equity intrinsic value came out around $1.67 trillion. That translates to roughly $135 per share.
$135 per share. And how did that stack up against the market price when the report was done?
Well, around April 24th, 2025, the stock was trading near $159 per share.
So a bit overvalued according to this specific analysis.
Based on these conservative assumptions, yes, it suggested slight overvaluation at that moment. But, and this is important, the report notes that if growth is higher, say, from cloud or AI really taking off, or if you use a lower discount rate, the value could be much higher, maybe $180, even $200 per share potentially.
Interesting range. And it makes you think of Buffett himself, right? Famously regretting not buying Google.
Absolutely. He called it a screw-up. Admitted he saw how well it worked for Geico ads, but just didn't pull the trigger on a big investment. Even the best miss sometimes.
So true. Speaking of investors, the report looked at what some well-known value folks have done with Alphabet stock. What did it find there?
Yeah, this is fascinating. We know Buffett and Munger regretted not buying. Munger felt he was slow to see Google's potential, didn't buy directly via Daily Journal, though he got some exposure via Lulu.
Ah, Lulu, the Chinese Buffett. What's his story with Alphabet?
Well, Lulu, who Munger greatly admired, has been buying actively. Started in 2022, then really ramped up his buying in 2023.
How much are we talking?
By late 2024, Alphabet was his second biggest holding, over 5.5 million shares, combining the GOGL and GOG tickers. That was like 39% of his U.S. portfolio at Himalaya Capital. A huge bet.
Wow, 39%. Does the report say what prices he was buying at?
It gives some ranges. He apparently bought Class C shares mainly in 2022, maybe $120 to $150 post-split, and Class A shares late 22, around $95, $105, then more in 23, between $165 and $189.
So he kept buying even as the price recovered.
Seems so. Suggests he saw long-term value even at those higher prices. And as of the report, he still holds them all, about 0.43% of the whole company.
So a big vote of confidence from Lulu, contrasting with the legend's regrets. What about someone like Howard Marks?
Marks at Oaktree largely stayed away. His focus is usually different distressed debt, other sectors. He's generally cautious on high-flying tech valuations. So no significant position reported. He acknowledged the business strength, but kept his distance.
And John Doerr?
Well, he's different. Kleiner Perkins was an early VC investor pre-IPO, so Doerr's been a long-term holder through that. Still holds a big chunk, around 2.6% of the stock.
Okay, so a real mix. Regret, big conviction buying, cautious avoidance, and long-term VC holding. Let's shift to the people running the show, the board of directors. Who's on the board?
It's a star-studded lineup, really. 10 members. You've got the co-founders, Larry Page and Sergey Brin, still there.
Naturally.
Current CEO, Sundar Pichai. The chair, John Hennessy, former Stanford president. Then there's Francis Arnold, a Nobel laureate in chemistry. Marty Chavez, former CFO of Goldman Sachs.
Heavy hitters.
John Doerr, the VC we mentioned. Roger Ferguson Jr., former Fed vice chair. Rem Schreiram, another early investor, and Robin Washington, former CFO of Gilead Sciences.
Quite the collection of expertise. Any red flags or points of interest about them individually?
The report stresses their strong backgrounds, says there are no reported fraud or criminal issues for any director.
That's good.
It does note Page has kept a low public profile lately and mentions a past legal thing involving J.P. Morgan and Epstein, but stresses Page wasn't accused of wrongdoing.
Okay.
For Brin, it mentions a past SEC inquiry about private jet use and some tabloid stuff, but again, nothing related to governance. It also notes the past Brin-Wojcicki family tie is just a Silicon Valley observation. Overall, it paints a picture of a highly qualified, seemingly ethical board.
Reassuring. Now, power dynamics. Who actually calls the shots when it comes to shareholder votes?
Right, this comes back to that dual-class share structure. Page and Brin hold Class B shares.
The ones with extra votes.
10 votes per share, yeah. So even though they only own about 11% of the actual stock, the equity, they control over 51% of the voting power.
51% just between them.
Pretty much. John Doerr also has significant Class B holdings, adding to that insider control block.
So big institutions like Vanguard, BlackRock, they own a lot of stock, but their vote doesn't carry the same weight.
Exactly. They own tons of the non-voting Class C shares and also Class A shares, which only get 1 vote each.
So their economic interest is huge, but their voting power.
Much smaller, proportionally. Vanguard might own, say, 7.4% of the total shares, but only control maybe 4.8% of the votes through their Class A stock. BlackRock, similar story, maybe 6.5% equity, 4.2% votes.
And the upshot is?
The founders' votes decide almost everything.
Which must make shareholder meetings predictable on certain issues. What kind of proposals come up?
Totally predictable on contentious stuff. You see proposals trying to get rid of the dual-class system or demanding an independent board chair.
Things shareholders might want for better governance.
Right. And lots of ESG proposals pay equity, content moderation, privacy, AI ethics audits.
And how do those votes go?
Well, public shareholders, including big institutions, might vote heavily in favor. But Page and Brin vote no. And because they have over 50% of the votes, the proposals fail every time for those structural ones.
Even if a majority of public shares support it.
Yep, we've seen that happen. A proposal to end dual class got majority support from Class A holders, but still failed because the founders said no. Management proposals, electing directors, routine stuff that all passes easily with insider support.
So economically shareholder-friendly with buybacks, maybe, but governance is tightly controlled. Let's talk more about those buybacks they've really ramped up recently.
Dramatically. It's a huge shift in how they use their cash. The report highlights massive programs.
Oh, massive.
$70 billion authorized for 2023, another $70 billion for 2025. That followed $50 billion in 2022. They've been buying back around $15 billion worth of stock per quarter.
$15 billion a quarter. Compare that to earlier years.
Tiny in comparison. Their first buyback in 2015 was just over $5 billion total. Then modest amounts until 2019 when it jumped to $25 billion. But just in 2022 and 2023 combined, they bought back over $130 billion. Cumulatively, it's over $200 billion since 2015.
That is an enormous amount of cash going back to shareholders. What's the thinking behind this huge shift?
It really signals maturity, doesn't it? They used to prioritize reinvesting almost everything back into growth. But the core business is so profitable, the cash piled up.
Investor pressure?
Likely part of it. Investors want to see returns when a company generates that much excess cash. Buybacks became the main way, especially since they only just started paying a tiny dividend.
And the effects, besides returning cash?
Well, it reduces the number of shares outstanding, which boosts earnings per share. That was good. It can also signal management thinks the stock is cheap.
What about the ownership structure? Does it change anything there?
It reduces the Class A and C shares out there, so existing holders own a slightly bigger percentage. And since the founders generally don't sell their Class B shares, buybacks actually increase their relative voting power slightly.
Interesting side effect. And how does this compare to, say, Apple or Microsoft?
They're playing in the same league now, in terms of the scale of buybacks. It's a clear shift to prioritizing capital return.
Okay, let's get right up to date. The most recent earnings report, Q1 2025. What were the headlines?
Generally stronger than expected. Beat expectations.
Revenue.
$90.2 billion. Up a solid 10% year over year. Google services, the ad stuff, mainly up 10%. Google Cloud, really strong again, up 28%.
And the core ad business, people were worried about AI search competition hitting that, weren't they?
They were, but ads held up well. Search revenue grew 8.5%. YouTube ads had double-digit growth. It seemed to calm those market fears.
So the AI integration isn't hurting ads so far.
Apparently not. Management said user engagement with the new AI search features was high, maybe even driving more activity. Seems their strategy of blending AI and ads is working for now.
And Google Cloud keeps powering ahead.
Absolutely. Hit operating profit in 2024 and kept that momentum with 28% growth in Q1 25. They mentioned winning big enterprise deals for AI cloud services too. Good for diversification.
What about the bottom line? Profits.
Very strong. Net income jumped to $34.6 billion, up 46%. Earnings per share, $2.81, way ahead of estimates. Operating margin expanded to 34%.
Wow. Any caveats there?
Some of that net income boost came from investment gains, but even stripping that out, underlying profitability looked very healthy.
And returning cash. Buybacks and dividends.
Still going strong. Bought back another $15.1 billion in stock, and significantly, they paid out $2.4 billion in dividends the first full quarter of payments. They even raised the dividends slightly for the next quarter.
And they still have cash.
Oh, yeah. About $118 billion sitting there. Lots of flexibility.
What was the overall feeling from management on the earnings call and the market reaction?
Management sounded pretty upbeat, talked about healthy growth, positive momentum, AI driving improvements, mentioned Gemini 2.5 coming.
Any caution?
The usual nods to macro uncertainty, trade policy, currency swings, but generally positive. The market liked it. Stock popped about 4% right after. Analysts said it quelled market fears.
So a good quarter all around. Now, to really get the long view, the report looked back over 20 years, right? 2004 to 2024. What are the big trends from that history?
Yeah, that 20-year look really shows the incredible journey. Early years, 2004 to maybe 2013, just hypergrowth, revenue doubling some years. Margins were high but drifted down a bit as they invested heavily.
Yeah.
Middle period, say 2014 to 2019, still strong growth, but diversification efforts started. First buybacks began. Margins were maybe a bit pressured by those investments.
And more recently, the pandemic era.
Right, 2020 to 2024. Bit of a slowdown initially in 2020, then a massive boom year in 2021, then some headwinds in 22, followed by recovery and strong performance in 23 and 24, marked by cost control and those huge buybacks.
Any weird years in that data? Anomalies?
The report points out 2017 looked a bit strange for PE ratio and net margin because of a big one-off charge from U.S. tax changes. But ignore that blip. The overall trend is just massive growth. Revenue, net income, free cash flow, book value, all exploded over 2 decades.
And valuation, did that change?
It definitely normalized. Started with sky-high PE ratios reflecting huge growth expectations. Those have come down to more reasonable, mature company levels over time.
What about profitability and debt?
Consistently high returns on equity, high returns on assets, and they've done it all with barely any debt. Very conservative balance sheet. And now, of course, dividends starting in 2025 mark another phase.
The report had charts illustrating this too.
Yeah, they visually confirm the story. Price tracking earnings pretty well over the long run. PE ratio compressing, strong margins with almost no leverage, and that massive growth in free cash flow and book value fueling the buybacks now.
What's the big conclusion from that 20-year perspective?
It just shows Alphabet's evolution into this incredibly profitable, financially sound machine, disciplined financial management, and now a clear focus on returning huge amounts of cash to shareholders.
It has been quite a journey unpacking all of that. So let's wrap up. What are the absolute key takeaways for listeners about Alphabet today and looking forward?
Okay, summing up, Alphabet is still hugely dominant because of advertising. That's the engine. But diversifying revenue through cloud and AI is absolutely critical for their future. They're juggling that need with serious regulatory heat and intense competition, especially in AI.
And financially.
Recent performance has been strong ads resilient, cloud growing fast, and they made a massive strategic shift towards returning cash via buybacks and now dividends too.
All right. And a final thought for people to chew on after this deep dive.
Well, given Alphabet's incredible reach, the data they hold, and how much they're pouring into AI, what are the really unforeseen opportunities or maybe the big challenges that could define their next 10 years? And maybe just as important, how does that complex relationship with regulators and with all of us users continue to evolve?
Definitely some big questions to ponder. If you want to dig even deeper, check out Alphabet's SEC filings or look more into the thinking of those value investors we talked about.
There's always more to uncover.
Thanks for joining us on this deep dive.